Hello, Jim here. Selling options is a great way to make some extra income each month. And probably the most important part of that is making great trades themselves. In order to do that, I'm going to talk about the most important aspects of a great trade. And I'm going to share with you what I think may be one of the best trades I've ever made. I made it a couple weeks ago. And I'm also going to talk about some other companies that could be very good candidates for this same type of trade. So stay till the very end where I'll share with you these companies as well as the trade itself. And with that being said, let's jump right in. Okay, now to find a great trade, it all starts with finding the right company. I've talked about this in a lot of previous videos, picking the right companies, or if it's an ETF, being sure that the companies that they hold are also great companies. Now you may ask, well, what is a great company? I'd like to start with debt. Do they have a lot of debt? I prefer no debt or very low amount of debt. I typically prefer a debt to equity ratio of below 50%, meaning for every $2 of equity, they may have $1 of debt. Actually, I'd prefer lower than that, but there's a lot of giant, really good companies that have a lot of debt and they manage it very well, and they do very well because of it. Next is consistent growth. Are they growing revenues? Are they growing profits? Are they improving their margins? Maybe not every quarter, but consistently year over year, they typically are doing well. Next is profitability. Do they have a really good return on equity, return on capital, return on assets? Are they using their assets in such a way that the company is growing and is a healthy company? Next, I would also look at their management. Do they have good, strong management? Or is management making the right decisions? Are they, marketing the company the right way, taking the company in the right direction? I also like to sometimes look and see, who the board members are. Who is the CEO? Where's he from? He or she from? How are they actually managing, the company's growth and direction? Sometimes you may find, or you may be surprised that the management isn't good, and you might find that maybe it's not what you expect, and that can also have a major impact on if you make an investment in that company or you make a trade related to that company. So next, the trade needs to be simple. Don't make it overly complex. Sometimes, especially with options trading, I feel like people make trades very, very complex. I think if it's a simple trade that most people can follow and you can easily explain it, is key to your success. Next is safe. Is it a safe trade? Does it have a limited amount of downside? How much of your capital is at risk? What's the chance that it blows up your account, or what's the chance you're going to have early assignment? All things to look at. A couple others, and I'm not going to go into a lot of detail on all of these, but also high liquidity. Are there plenty of trades? Are there plenty of volume, of open interest, of contracts out there that you can easily trade options on the particular stock or ETF? And I find this is more and more important, especially as more and more people start trading options. To me, a part of picking a company also is to ensure that there's plenty of, option volume, option expirations, plenty of strikes. Sometimes strikes can be limiting just or just because of the nature of how they're set up. So some companies may have $5 strikes, so it's like every five, or it may be 5, 10, 15, 20, or your choices for stocks or strikes for that stock. Or it may be like 1, 2, 3, 4, 5, or I've even seen $10 separation for the strikes. So having strikes that are closer together where you have more choices, and also having more expirations, like something along the lines of daily, at least weekly, but even daily expirations is a great bonus for being able to, manage your trades. Next is a favorable risk reward ratio. So again, how much risk are you taking? Are you bringing in enough premium for it to be worth making that kind of a trade? Strong technicals. I'm less technically inclined. I like fundamentals for the company, but you can look at the technicals, not just for the company, but also for the trade itself, when it's the best time to actually make that trade by looking at the technicals. At times it may not be worth making the trade, or, you may be looking for a specific technical that means it's a good time for you to make the trade. Maybe it's hit a lower band or an upper band, or something that makes it easier to understand if it's a good time to make the trade. For instance, resistance levels, once it hits a resistance level, it may be a good time to make a trade at that time. And other times it may not be. Positive earnings outlook, again, it's if the company is growing and has plenty of income. A good portion of the mistakes I've made are all related to companies that weren't growing, their outlook for earnings. And I really like to use year-over-year guidance for the particular companies that I deal with. And I prefer to see pretty nice year-over-year earnings growth. And that can change on a heartbeat. So you also have to keep track of the news for the company, what possibly is changing, what kind of things, maybe this isn't such a good stock anymore because of guidance is radically changed. I have noticed recently that guidance is a bigger impact, more so than profits. So if they give negative guidance, or they, compared to previous quarters, the guidance has come down quite a bit. That can also impact your choice of making that trade. Good volatility, again, for trading options, it becomes the more volatile, there's more premium, more opportunities for trades. But again, that comes at a risk. So in some cases, I prefer to trade less volatile stocks like Coca-Cola or Southern Company or companies along those lines. And then having a clear exit strategy. I get lots of questions, how do I close my trades? I like to manage most of my trades. This is why I have what I call my planning worksheet, that typically 3 weeks out, I add any positions that are closing to it, and then I actively manage those. Now, I prefer to do that. Others may do it differently, being that I have a good number of trades or positions at both Schwab and Fidelity, and they work differently. I just find it a little bit easier to manage. Now, I don't do stop losses currently. It's something I'm looking at doing, and potentially adding those, as well as, manually, taking care of the trades, especially as they get closer to expiration. But I found that the planning worksheet works for me. So when something's working, I typically don't change it or modify it in a huge way. I try to make a little bit of improvements here and there and slowly better guide the ship. I don't do radical changes. I do kind of slow and steady, if you get my drift. Strategic timing, I'm not going to dig deep into these. As you can probably tell, I actually got this from ChatGPT, but I'll share this again with my memberships. I had a request from the last video like this to share the list I had come up with at that time. So when I release this video to my membership, I'll actually provide this too. And if you're curious about my memberships, you can learn more below. More and more people are joining. I've gotten some advanced traders that are sharing their trades and helping other members, which is wonderful. That's kind of what my goal is. I want everyone to learn how to do this. And I also want to be very open to what I provide and easy access. You don't have to jump through hoops to get access to me or to get access to my members. It's something I pride myself on. I look at a community that's learning together, in a way, getting rich together, or hopefully getting rich together, if you get my drift. So that's the main part. These are the main criteria. Next, I'm going to talk about the trade that I think may be one of the best trades I ever had, and I'm actually looking at doing it a lot more. I'm going to share with you a couple of other companies that you could do this trade on. So let's jump into the next part of the video. Okay, this is my planning worksheet from about 3 weeks ago, and I had one trade that kind of blew me away. At first, I was like, well, this can't be right. I must have to recalculate it because the return was so crazy. But it was Zoom. I did back on May 7th, I did what's called a reverse jade lizard. So it's an iron condor, but without purchasing, a call, mainly because you already own the shares, so you don't need to purchase the call for protection. You already own those shares, and you've done the covered call in such a way that if it gets assigned away from you, you're going to do well, well enough that you're not really that worried. You don't need to buy the call. So it's really a three-legged trade versus four for an iron condor. It's pretty much an iron condor without that fourth leg. And I did a 60-55 put, and then I did a 65 call. So the vertical put credit spread was 60-55, and then the covered call was a 65 call, expiring on 6/21/24, and this was for one contract. Just keep that in your mind, just one contract. So there were, just the fact that it's a $5 spread, one contract, that's really only $500 for protection. And I brought in $413.96. Now, Zoom was down quite a bit that day. And also, I've talked about it in a lot of my other videos. I really like Zoom. Some people don't. I use them. They're one of my favorite companies currently. They have no debt. Any company that has no debt, I feel like, is pretty amazing. And they've been growing nicely. They have great profitability. Their management is good. They're well compensated, which I think that's probably the biggest issue Wall Street has with them. I think the founders are still very involved, and they are getting some pretty hefty compensation. I think that'll change down the road. But I brought in $413.96, and then my required capital was 86. That's literally just the 500 minus 413.96 gives you 86.04. So that's like my max loss. I could lose $86. And now if you plug this into a yearly return, it's 3,902%, which when I first saw that, I thought, this is crazy. This can't be right. But it's this divided by this adjusted for the year. So 413 divided by 86 times 365 divided by 45. So the DTEs are 45. And the reason that it's so high is the cost of capital is so low. Now, I've always calculated cost of capital, especially for iron condors. You pick one of the sides, and since the real risk is on the put side, you take that $5 spread, multiply by 100, and that's how I come up with 500. You may disagree. Leave a comment if you think I'm calculating it incorrectly. I'd be curious to hear from you. I try to answer most of the comments like that within 24, 48 hours. So this to me I kind of kept it in my mind. I didn't really think about it, but I thought, well, I need to dig a little bit deeper. So what I did is I came out and I looked to see, could I do this again? And this was just literally yesterday. So the market is closed and Zoom was way up. So again, the amount of premium is less. If Zoom had been down $1, which I believe when I did that original trade, it had been down quite a bit. And I do encourage people to sell puts on down days and calls on up days, especially for the stock. You'll even see it in the option chains, where if it's an up day, you'll see negative values for the changes in the puts and vice versa. So I just threw the numbers in again. This is in my brokerage. I use Schwab, but you could also do this with Fidelity. So here you can see the put spread, same scenario, 60-55, 719. I like to do monthly expirations. So again, a $5 spread, one contract, and here's the covered call. Now my cost basis on these are about $61 or $62. So again, I would pick up a pretty good return. I believe they were assigned to me a couple weeks ago. So I would bring in literally 273, which is still pretty impressive, especially on a big up day for Zoom. So next I decided, well, let me see what, I hit the wrong button. Let me see, what does it look like if you go out to March of next year? You do this almost like a leap, and the numbers even got a little bit crazier. So here, same kind of trade, but the expiration date is 3/21. and the numbers got really big. I would bring in nearly $1,000. Now, if I went with the midpoint for the limit, which I probably would, you do bring in 10,000 or $1,275. And then I decided to do some calculations with that. So this is expiring in July. This is my original trade that I did, the 413.96. And you can see on a yearly basis, if I only did it once, and again, I'm assuming that's the only trade you did through the whole year, it would still be a 93% return on a yearly basis and a 12%. So, very, very good. And that's also with being assigned. So I'm assuming, well, what if it gets assigned? Because in a way, even though I said if they're assigned to me, so in this case, I'm looking as if the shares were assigned away from me to come up with a yearly return. So I would come out with 713, which is a 12% return, but 93 for the year on a yearly basis. And then I did the same thing with expiring March of next year, again, being assigned the 100 shares being assigned away from me. And again, the return would be really good. So this would be like making one trade, and say you had an account with that kind of money, you would have that big of a return. Now, most likely it would happen a lot sooner. You wouldn't just have one trade. So this would close and then you would open another trade. And that's what I'm showing here. So expiring in 1 year with monthly trades, and you can see that it would be 6 trades, but you would bring in quite a bit more money. And then if it's assigned, your net would be a bit higher. So 45% would be the return. And then adjusted yearly, it would be almost like 55%, mainly because I'm using, it's 6 trades, and then I would have a little bit of time left over. So you could do really, really well with this. And I think the difference I've done, like I mentioned before, I have done reverse jade lizards on Coca-Cola and Cisco, and they don't have huge amount of volatility. They don't typically have really good premium. Now, a company like Zoom does. So pairing, the pairing of 2 short positions, one a call, one a put, and only purchasing protection in one direction really brings in a lot of premium in these kinds of trades. So the next thing I decided to do was, are there other companies where I could also do this with? So I thought I'd look to see what it looks like if I throw it in the trading page. So I also looked at Shopify, because some of these, they just got assigned to me recently. And lo and behold, it looks good. I could do a 55.50. It's currently at 57, so it's a little bit closer to the current price. But I wanted to keep it as similar to Zoom as I could, and even the numbers are fairly close. And again, this is for one contract. And then I did a 65 call, which I believe if I got 65 for my Shopify, I'd be making probably a $3 profit at this point, not including this $2.29 credit. Again, this is expiring in July 19th, and they were down. So almost as good as Zoom, maybe not quite as good, but you could play with the numbers some more and really see what it looks like. And the fact that I currently have 2 covered calls, I may close those and do this next time. And I have some other companies I could do this with, especially if they get assigned to me. So let's look at one of the others. Palantir, everybody loves Palantir right now. So here's what it looks like with Palantir. And this is, again, one contract. Now, Palantir is a lot cheaper than the other 2, Zoom and Shopify. So Palantir, you're talking, and this is a much thinner spread. So I decided, well, let's play around a little bit. So I did again, one contract expiration, and probably I wouldn't do just one contract. I'd probably do 4. But I did a 1917 put, so 200, and then I did a covered call of 22, assuming that my cost basis is probably like 19, so I could make a really good return. And again, I brought in over $121 for this return, and again, it would be, a significant profit on this kind of a trade. And like I said, I probably wouldn't do one, I would do four. So this would generate close to $500. I think it'd be like what, 470, 475 for literally $800 of required capital, or your max loss would be like $800. So again, it's a significant difference. I wanted to do one more, so let's do one more. Let's come back. And this is a lot like Palantir, but instead of Palantir, I did it on Path. Path has earnings coming up this week, I believe on Tuesday or Wednesday. I believe it's the 29th. I think today's the 26th, so it'd probably be Wednesday. But I did this with 4 contracts. I did it with, again, 1816, similar to Palantir, $2 spread and a $22 call, assuming, if these are assigned to me, my cost basis would be around 19. And there again, at 134 is the market. I probably would do the 1395 or see if I could do that amount. But even with doing market, you're talking $536 with, again, required capital would be 800 minus, or 200 minus 134. Again, you get some crazy profitable numbers. And it kind of points to another type of trade a lot of members have been talking about in the community, where you buy some shares and then you sell a covered call at the same time, and it can work out really well. And I think for something like Path or Palantir, that's another great opportunity to do it. And if you want to learn more about my memberships, take a look below. They're growing. I have a lot of advanced members joining. They're advanced in options trading, and they're helping a lot of the beginners. They're answering a lot of people's questions. Some of them are probably more advanced than me. I'm more of a fundamental trader. Some of them are very technical. And I'm learning from them along the way too. I'm watching their trades and asking a lot of questions too, which is really nice. I pride myself of being an open community, an open membership. You don't have to jump through hurdles, and you can access it. You can reach me fairly easily. It's, something I want it to be is easy and open to access, where people can, go someplace to really learn, versus being really locked down. I think some of the other YouTubers have memberships that are really locked down. I believe you have to have a phone call with them first and all sorts of hoops to jump through. So this is, the trades that I'm looking at. I'm looking at making some more of these. I might even look, if we have a downturn, of buying some of these and then doing this kind of trade exactly, because again, it's so profitable. So let me know what you guys think. Do you also see this as a great opportunity? Or am I missing something? Is there something about these trades that are not as good as I presume them to be? So as always, thank you for joining me, and I look forward to seeing you next time.